Hello everyone, welcome back to the channel. Hope you've been well. Today we've got our regular portfolio update and there's a decent amount to go through, so let's head on. Alright, so to take a look, here we are. We've got our US and Canadian dollar portfolio again. You can see there really hasn't been much movement at all in terms of the actual portfolio value. And that's due to mostly just the stocks that I have currently in the portfolio. We've been seeing a lot of ups and downs in the market, and so it's kind of just been evening out a little bit. If we take a look at the Canadian graph, you can see that there's been an upward tick in that portfolio. I did deposit some money recently, so that is actually the majority of the increase here on this portfolio graph. When we take a look at the Morningstar report, you'll be able to see kind of the book cost versus the current price cost. As for the US dollar, last time we talked about this steep decline in market value. From last episode till now, we've actually been fairly flat. It's actually come down a little bit again, but not a whole lot. So in times like this, the toughest part is actually to stay the course, right? When you're seeing your portfolio initially have a lot more money in it and decline to, a drop of about $10,000 almost, the toughest part right now is to stay the course. But being an experienced investor, we have to make sure we stick to our game plan, and that's what's going to give us those long-term results that we're looking for. The other thing I'll want to talk about today after we go through the portfolio is ARK Invest has put out their price target for Tesla. And ARK is known as a very bullish Tesla investor. So let's take a look at kind of their price targets, what they see as the best case scenario and the not worst case scenario, but a more negative or a bear case scenario as far as their price targets. And we'll also go over the assumptions as to how they came up with those targets to see if it's reasonable or realistic, so that we can see how accurate that price target may be 4 years down the line, because the price target that they put out was for 2025. So if we take a look at the Canadian portfolio, it's actually been pretty consistent. There hasn't been a whole lot of movement. A couple things that have come up recently since we last took a look has been Canadian National Railway. That went from a negative back up to a positive. And remember, this was a stock actually that we had originally purchased in the US funds, and we switched over to Canadian. So the original base cost of this probably would have been around 125, 130, but it has come up since then to be back up in the positive. We've got Andlauer Healthcare and Alimentation Couche-Tard. Both of those are in the positive as of right now. New technology companies that we got into, Constellation Software. So that's around flat, a little bit on the negative. And then Lightspeed has actually been resold and purchased due to actually tax optimization. So one of the strategies that I will employ from time to time is to actually realize some of those losses. And the reason why we do that is because when you sell a realized gain, you have to pay taxes on it, of course, unless it's in a tax-free savings account or RSP, but this account is not in one of those registered products. So anytime we sell a stock and we have a realized gain on it, we have to pay taxes on it. So to offset that, sometimes when we purchase a stock and it's not doing as great as we thought from the get-go, I'll actually sell it and realize that loss, so that in the future, when I have a capital gain, those will actually offset off each other, and that'll reduce my taxable income. Shopify is another one, and this is probably the main dragger of my portfolio right now due to the valuation reset on a lot of these growth stocks. Shopify and Lightspeed even, these were stocks that were about 30 to 40% higher just about 4 weeks ago, and they've really come down since then. So Shopify is the main dragger in the Canadian portfolio. And then we have TELUS, which is fairly flat, and then we have Well Health, which is fairly flat. But both of these have actually come down quite a bit too. Not so much TELUS, because TELUS is more of a blue chip steady stock, but Well Health even has come down roughly about 20-30% since its recent highs. So next we've got the growth US portfolio. Now I have shrunk this a little bit more. Instead of having the coin flip US portfolio, I decided to just input it into the growth one, so it's a little bit easier to manage. Of course, we still have the cash portion of this, so the cash will always stay there so that I can keep track of how much cash. Right now, there is actually quite a bit more cash than usual because of the dips in the market and the volatility in the market. So I have left some cash here that I have been using to buy the dips with, but as it doesn't really look like the market has hit a bottom yet, and the valuations have not fully been accounted for due to the fluctuations on the bond yields that we talked about in previous videos. I will be utilizing this cash throughout the next little while to buy more dips if they come up, and even restructure my portfolio if required, right? Because one of the strategies we talked about was to sell some of the less conviction companies, realize some of those losses, and put them into more of our higher conviction companies. So as you can see, as a whole on this portfolio, it is still up compared to my book cost. My book is about 76.6. My market currently is about 80,000 US dollars. But as you can see, there is quite a few companies now that are actually in the red, right? We've got probably almost, at this point, maybe 65% of the portfolio that's actually in the red. And that's just because as we've been purchasing companies throughout the last few months, we've been doing these stock videos. A lot of those have come down 20, 30, 40, 50% even on some of them. And so we've been utilizing the opportunity to buy the dips and actually sell off some companies as well. For example, there's been a lot of talk about US and China trade talks, right? The Biden administration came in. They don't seem to be any easier on Chinese politics. And so as a result, there have been some Chinese companies that have really taken a dip the last about week and a half or so. And so there was a company that we had on here, would have been Tencent Holdings. They're probably the top 5 largest company in all of China. And we've actually sold out of Tencent Holdings just purely because of the political play, or the political instability, I should say. So going through these current stocks right here, there's been, as I mentioned, quite a bit of move on pretty much all of them. They're all roughly down at a minimum of 5 to 10% or upwards of 40 to 50% from their recent highs. There are a couple companies that I'm really looking at in terms of buying the dip. Fubo recently had a very significant dip today of about 15%. Remember, this is the sports betting and sports streaming company. Very much a long-term play, at least a 3 to 5 year time period. Has really high potential for 5xing or 10xing in the next decade. And so I do like this stock, but there's a lot of execution risk in there. Currently, it doesn't make up a lot of my portfolio in terms of my total cost. So I will very likely average down this company so that hopefully in the future, when it goes up, I'll be able to take more advantage of it because I'll have a bigger cost base. And B, if it really doesn't, it's not a huge part of my portfolio anyway, so I won't be hurt too much, even if I do double down a little bit. A couple other companies that I will definitely average more into. Let's take a look. Palantir, I've already started averaging down into it. I'm up to about 90 shares now in this company. If it continues to stay in this low 20s, and even if it breaks 20 going into the high teens, this is a company that has shown amazing execution so far, and I do believe is set up well for the long term. I don't know if it'll have 10x potential. Eventually, I wouldn't be surprised if it got there, but in the short term, meaning the next 2 to 3 years, I do expect this to be at least a $40, $50 stock fairly easily. PayPal is one of my higher conviction companies. I haven't really averaged too much down into this one yet because it hasn't even dropped below my book cost. It has come down since its 52-week highs, but this is one that I'm definitely going to keep an eye on. Even if it doesn't go below my cost, I will likely average into it a little bit. Roku, certainly one that will have my attention when it comes to averaging into. Teladoc, I've been I wouldn't say pouring, but I've been certainly putting more money into this company. Long-term potential for this is great. It has recently taken a beating since Amazon mentioned that they would start their own telehealth service and broaden their services through their employees. They have been trialing it for the last little while, but the beauty of Teladoc Health and the beauty of why we believe in this company is not purely because of the servicing capabilities that they have. A large part of why we really think that this could be a great company is because of the data that they're getting with their Livongo acquisition last year. And all that data is something that theoretically should be able to translate into ease of use with their customers, should translate into cost savings for them for higher profits. And 3, that data is also being used to service their artificial intelligence proprietary technology to help diagnose with chronic illnesses. So even if Amazon gets in the game, Teladoc is well ahead of where Amazon is, and this is not a space that can be easily broken into. There are high barriers of entry, and so if Teladoc continues to execute the way they are, this will be a no-brainer in terms of how big this company can grow. Now, what I find super interesting is always to compare our research or my research with other companies' research. And ARK Invest is a huge company that obviously has way more resources than I do, and they've been extremely bullish on Tesla. So they were one of the ones that estimated that Tesla, or not one of the ones, they were actually the only one that ever said Tesla would hit $7,000 per share in 2024, or $1,400 adjusted for its 5-for-1 stock split that recently happened. They've since adjusted that price target, and they've actually raised it from an estimated $1,400 adjusted to $3,000 in 2025. And to be clear, this $3,000 price target is not the best case scenario. They've actually listed it out for you here below. The expected value based on probability is the $3,000 price target in 2025. The bear case, meaning the downside or if things don't go as according to plan, they still forecast a $1,500 price target, and there's only a 1 in 4 chance that they believe Tesla will be worth less than $1,500 in 2025. The bull case, if things go well, they estimate a $4,000 price target and a 1 in 4 chance that Tesla could be worth $4,000 or more in 2025. Now, to give you a bit of context as to how that actually looks, Tesla's currently trading at a $618 stock price at a basically $600 billion market cap. So they're basically saying in 4 years from now, there's a 1 in 4 chance that Tesla only doubles or 2.5x's, putting that company at about $1.5-ish trillion. The most likely scenario in their mind is it goes to $3,000, which is roughly a 5x. So the company is now worth $3 trillion, which would make it the biggest market cap company in the entire world, bigger than Apple currently, which is the current largest at around $2 trillion or just shy of $2 trillion. And then the bull case, which is a best case scenario of 4,000, 6.5, almost 7x what their current price is right now, and about a $3.6 trillion market cap. So let's take a look at that research to see if it's realistic and if So let's take a look at some of these cases that ARK has set out for Tesla. They currently have the 2020 scenario. So in 2020, Tesla sold 500,000 units of cars. They expect in the best case scenario to sell 10 million cars and the worst case to sell 5 million cars. For your reference, the largest car manufacturer was Volkswagen in 2019. The 2020 data is not fully out yet, and also 2020 was a down year because of COVID, so that's why we're going to use 2019 instead. And so in 2019, the largest manufacturer was Volkswagen. They sold about just under 11 million units. So essentially in 2025, Tesla would have to match the largest car manufacturer's numbers in the best case scenario, and in the worst case scenario, the $5 million at half, which means that Tesla would have to grow at 10x the number of cars that they can sell. There's a couple restrictions on that already. Right now, obviously, Tesla's capability is nowhere near there. They don't have enough models of cars to get also to 5 million units. They've only got 4 models right now. They do have another one coming out, and of course the Roadster, and they've got those Cybertrucks. So as Tesla grows their number of SKUs and as their gigafactories get built, because right now they're also limited by production, right? It's not just demand. Demand is actually outscaling production right now, but demand is also not right now in the $5 to $10 million units per year. So we'll have to see how well Tesla can scale that up. And the other thing that's really important is the way they came up with their revenue was also the average selling price of the car, right? So the average selling price of the car, you would expect as it goes down, you open up it to a larger market, so more people would buy the vehicles. This $36,000 will really be interesting to see if Tesla can get to, because right now, even with all the incentives, the cheapest Tesla, it's still quite expensive. And so if we go back to that Volkswagen example, Volkswagen's average sales price per vehicle was about $27,550, but they've got the luxury of using, mainstream technology, really built out, mass produced to keep the cost low. If Tesla can reduce their battery costs, and if there's a lot more innovation in the battery space, which there does seem to be, the solid state battery especially being one of them with respect to performance, but that's currently quite a bit more expensive than even the lithium ion batteries. So this $36,000 is roughly a 30% decrease in their average selling price. And right now, it'll be tough to say whether that seems feasible or not. I think that there's a world where it could certainly happen. This $45,000 number, on the other hand, is certainly feasible for Tesla. So right now, I would say that the bear case scenario seems more realistic than the bull case, but that's only with the information I have now. The next part we've got here is very straightforward: electric vehicle revenue in the billions. So that's basically just the average selling price times the number of cars sold, and that gets you the rough electric vehicle revenue. Now, essentially, the main difference between the two different types of cases, between worst case and best case scenario, is how Tesla starts diversifying their income stream. So on one hand, they will have insurance revenue, which Tesla is actually already doing because of the amount of driving data that Tesla collects from any driver who drives a Tesla. They've been able to utilize this data to now insure automobiles themselves in order to get revenue from it. But going back to the two streams, essentially, if the worst case scenario states that their insurance revenue will be higher than in the best case scenario, but that's not the space where you can really make money. The space where you can really make money right now is going to be autonomous driving. And so you can see here when they divide it down into human-driven ride-hail and autonomous ride-hail. So part of this process that ARK believes is that Tesla will get into the ride-hail market. So think your Uber and think your Lyft. So human-driven, not a big deal. That's just basically a regular Tesla, a regular guy who owns a Tesla, using his Tesla to get revenue. But in this case, ARK is saying, hey, Tesla, why don't you get in that game? Because A, you're not spending gas, right, when you're driving people around. So why don't you guys just create your own network of ride hailing and get into that market? Compete with Uber, compete with the Lyft, but branded under Tesla. That's not that exciting. What's really exciting and why it falls under the bull case is because Tesla is light years ahead of anyone else in the autonomous vehicle game. There's talks about Apple getting into this game and making an Apple car. But the one you hear most about is Google, right? Google's been doing tons of miles of autonomous vehicle driving, but they're not even close at all to the amount of data that Tesla has. Tesla has, I believe, about 5 or 10x the amount of miles that Google has. And so this is where ARK believes that Tesla can really flex their muscles. If they can come up with an autonomous ride-hailing service, so basically you sell a Tesla to someone at full price, for example, maybe a Model 3, then they utilize that autonomous ride, that basically auto driving capability of the Tesla model, whatever it ends up being. They can get into that ride hailing game, so they can charge someone to go from point A to point B, and Tesla will take a cut of that. Or if it's just Tesla's own fleet, then they will create a fleet of self-driving cars. They can get max revenue for it, and have much larger revenue, but more importantly, much higher gross margin on this revenue. So they believe that if they go about it that way, they will come up with a rough gross margin of 50%. And as you can see, the electric revenue of 367 is going to be very close to this autonomous ride-hailing revenue of 327 billion. To me, that is their main argument of how they believe Tesla can get to a $4,000 price stock. I don't think that's realistic by 2025. There's a lot of data that still needs to be collected in order to make this happen. Tesla has not shown to this date that they're able to keep with any of their deadlines, even though they really are pushing this autonomous driving. There hasn't been any real concrete mass market demonstration to show that they can, and it's only 4 years away. If they want to be fully into this market and to generate this much revenue by 2025, they would have to be into the market at the very latest by next year or the year after in order to be able to mass produce this. So I really don't think that that's going to be very likely. The other thing is these margins. These margins are very high for even a tech software / vehicle manufacturer, because at the end of the day, they are still a vehicle manufacturer. If we just take a look at this best case scenario of 50% margin, car manufacturers don't have 50% gross margins. Now, if Tesla is able to mass produce, they're able to lower their cost on the batteries, I'm sure they will be more profitable than, let's say, a current Ford is or a GM is. Their profit margins will probably be higher, but you're still looking at maybe 25, 30 points. Vehicle insurance, currently, a top large-scale auto insurer as of today, they're doing about 13, 15% in margins. So all those numbers are going to drag it down. Now, to ARK's credit, they believe that this autonomous ride-hailing margin is going to be upwards of 70, 80% margin. So if you take a look at those 70, 80% margins on this, you divide it by probably the average of this margin, which is going to be around the 25, 30, maybe about 20, 25 points. You can realistically, I suppose, come up with the 50% margin. But then the other question is 70, 80% margin on autonomous ride hailing really realistic? And at these figures, right? So that's really for, everyone to decide on their own. I think that the bull case is definitely way too bullish. The bear case revenue, I actually do think is going to be more likely than the bull case. I know they gave it a 1 to 4 odds, same as bull. And even in their expected value, they put more weight towards the bull side, as you can see, because this $3,000 leans more close to the bull case price. So we'll have to see. These are very lofty expectations for Tesla to hit. Whether it can be done, the future will tell. There's so many car manufacturers right now that are getting into the EV space. And that's, of course, because of Tesla, right? Because Tesla is the pioneer in this space. I think that because there's so many getting into the space, this $36,000, I don't know if this part will be the tough part. I think it'll be, how do you get to $36,000 while maintaining a really solid gross margin higher than their competitors? Because they have the first movers advantage, and because they're ahead in AI and driving data, it'll certainly benefit them. But it'll be really tough, in my opinion, for them to hit this mark. But that is the fun of stocks, right? It's to see how accurate your predictions are, to see if you can hit the button on the head, and if these companies can execute too, right? All this data that you have, you can logically put it together, but execution risk is a real thing. And so far, Tesla's been hit and miss on that end. They've been great at delivering 90% of what they say they're going to deliver. Never on time, but they do end up delivering. So I do believe that the company has the ability to make this happen. And like I said before, I don't want to bet against Elon Musk. The guy is sending rockets and people to the moon. So it'll be really interesting to see what happens. I am bullish on Tesla from the $600 price target that there is now. I do believe that there is real room to appreciate when it comes to the stock price, and so I am a shareholder. Do I think it's still overvalued right now, even with all these factors? I do. I think it still has to figure out a way to grow into its evaluation, and maybe in 2021, 2022, as their car manufacturing capabilities get more mature, they'll actually start growing into that side of the business. And once they finally mature on that side of the business, you'll see inklings of the autonomous ride hailing or even human ride hailing if they even decide to get into that business. So it'll be really interesting to see what the future holds for Tesla. As always, thanks for taking the time to listen. Please like and subscribe if you enjoyed it. And obviously, if you think somebody else can benefit from the lessons that we're talking about here, please share it. Any questions, please feel free to leave them in the comment below, and let me know if you think Tesla can actually hit these price targets. Can they hit this extremely lofty price target that ARK has put out? It'll be a fun ride, and I can't wait to enjoy it all with you. Thanks, guys. We'll chat with you next week.